In this presentation, we will continue on with our corporation comprehensive problem with the purchase of supplies. For more accounting information and accounting courses, visit our website at accountinginstruction.info. Our information is going to be up top. We're going to enter that into our general journal. Then we'll post that to the general ledger. So we have the purchase of supplies for $16,000. First question, is cash affected? And we're going to say in this case, no, it's not affected because we purchased it on account. Now in practice, we would know that for sure. In a book problem, it's probably going to say something like on account or on credit, or we had to purchase. It's going to indicate some way in the terminology that we did not pay cash for it, kind of like purchased it on a credit card or something like that. And therefore, we just need to know that. So we got to get used to the format of a book problem when we work through comprehensive problems. So that means that cash isn't affected. I would think then about what we got. What we got are supplies. Now even that can be a little confusing because we note that we have two supplies accounts. If we look through the trial balance, which I always recommend having in front of us, then we've got the trial balance and we've got supplies up top in the assets in green and supplies up down below in the expense accounts in the dark blue. Now, which one should we use? In practice, it's going to depend on whether or not the supplies are significant. So if we're just buying like staples or something like that, then we're probably just going to expense it because the dollar amount is low. Even if we bought a year's worth of staples, it probably is not worth it to us to count the staples and see how many we have used. If on the other hand, we're buying like medical supplies or we're buying, a lot of computer ink or something like that for the printer, and we do want to track that to make sure that we are accounting for any kind of shrinkage and it's significant to the financial statements, then that's going to be our introduction to inventory. And that's often the introduction to inventory for many textbooks as well, because we're going to put the supplies on the books as an asset, and then we'll track it. How? We're going to count it periodically and see how much we have used. And that will be an attempt then to expense it as we consume it rather than when we purchase it. And that will be better accounting from an accrual standpoint because we're going to be recording the expense when we actually use something. It's not just being triggered by when the cash is happening, which can cause problems. Because remember, if I paid $16,000 worth of equipment, that could be a year's worth of equipment. If we expense it in month one, in January, then we're really going to distort net income. Net income is going to be highly distorted for the first month as compared to other months, because every other month we're not going to have to buy inventory because we already bought it. So that means that that's not a very good way to make comparisons. It's better if it's significant to put it on the books as an asset and then expense them as we consume it, because that's more fair to the months for comparison purposes. So what's going to be the journal entry then? The supplies are going to increase. Supplies is an asset up here. Like cash, it's going to go up in the debit direction. Like cash, it has a debit balance. We make something go up by doing the same thing to it, another debit. So we're going to debit the supplies, and then we're going to credit the accounts payable. So instead of crediting cash, instead of cash going down, we didn't pay cash, accounts payable is going up. Now this is the reason I would think of what we got first, because we probably have a lot less usage of liability accounts and may not remember that they are a credit balance account. And so if we do the asset first, we can say, okay, the asset's going up, therefore we must be crediting the other account, and the other account then is accounts payable. Then we go back and think through it. Does that make sense? Well, accounts payable is a liability account. Liability accounts have credit balances. It needs to go up. The bad thing needs to go up because we owe more money. And therefore, we do the same thing to it to increase it, which is a credit. Now, we'll see this as we go to the general ledger. So we're going to post this. This is journalizing the general journal in the general journal. Journalizing the journal entry in the general journal is what we did here. Now we're going to post it to the general ledger. So here's the general ledger. And again, it's going to have all of the accounts in order: assets, liabilities, equity, income, and expenses. It's in the same order as the trial balance. We're looking for supplies and accounts payable. So if we look through the assets for supplies and then the accounts payable here, those are the two accounts that we will be dealing with. We'll focus in on those accounts now. So here's our journal entry. Here's the supplies. Here's the accounts payable. Supplies is a debit balance account. We debited supplies, I should say. It is a debit balance account as well. It's starting at 0. We're going to debit it. So here's the debit. It's going to bring the balance up in the debit direction to 16,000. The accounts payable, here's the accounts payable credit in the journal entry. Here's the general ledger. It's at 0. We're going to credit 16,000, bringing the balance up to 16,000 in the credit direction, represented by the brackets. Now we're going to use these accounts in order to construct the trial balance. So here's our trial balance. These are the two accounts that are changing. Everything else is the same from the prior time period. So what changed is the supplies account, which we're going to pull from here. Again, you probably only have one supplies account. You don't have to retype the 16 all the way down, but just from computer purposes, this is helpful. And so that 16,000 is being used now to create the supplies account. And then the accounts payable is coming from here. So the accounts payable, again, you probably only have this one. You don't have to enter the running balance all the way down. We just have the 16,000 is creating the accounts payable. If we took the debits minus the credits, we're still going to be in balance here. So we're going to say that we have the 40,000 cash plus the 16,000 plus the 60,000. That's 116, which we owe to 16,000 liabilities, and then the rest is owed to the equity section. So now we're saying, note that we have these assets here, but there's a claim to part of those assets that isn't the owner's. 16,000 is claimed by someone other than the owner, third parties. And then the rest, the difference, is going to be what is owed to equity. So in other words, we could say the assets minus the liabilities is going to equal equity. So we could say the 40,000 plus the 16,000 plus the 60,000 minus the 16,000 is 100,000. That's what the equity is. So the equity is always kind of like the book value in the company, meaning if we were to sell the company, if we were to liquidate it, we would sell the equipment for 60,000 if we could get it. Again, that probably would differ than the actual value of the equipment, but we would, if this was valued perfectly, then that's what we would have. We would pay off and we would sell the supplies for 16,000. We'd pay off the accounts payable, leaving us with 100,000 cash that we can then use to pay off the owners. So that's how the whole thing would fit together. Here's going to be the journal entry and the end product that we have here. Note that there's no effect on the income statement. What happened here is that supplies increased and the accounts payable increased, meaning assets increased, liabilities increased. Nothing happened to the income statement yet. It will affect the income statement, this purchase of supplies, when we do the adjusting process. So that at the end of the month, we're going to count the supplies. We're going to see how many are left and therefore also how many have been used or consumed during this time period. Then we will decrease this amount and record the expense related to it, and that will decrease net income. For more accounting information and accounting courses, visit our website at accountinginstruction.info.